All right. Do Michael DeRee, regular here. Thanks for tuning in, Michael. Do you pay closing fees each time you decide to refinance? Josh, refinancing, am I paying cost every single time?
There are closing costs every time you do a loan. So the ones that are always going to be there: escrow, title insurance, recording fees. So all of that stuff is going to be there. We do a lot of our loans no cost. So people go, oh, so it's a free loan. Well, it's not necessarily free. What happens is you take a slightly higher interest rate, you get a credit from the lender to cover those costs. The reason why we do a lot, if not the majority of our refinances that way, is going back to 1982. We've been in a 40-year bull market in interest rates. Interest rates have gone down, down, down. So in essence, what we're saying is do a free loan today so you have no sunk costs that you would never be able to get back. So if in 2 years or 6 years, when rates go even lower, we can do it again at no cost, and you always protect your ability to keep rolling down. You might be leaving 1/8% of interest on the table, but over time, when we pencil it out, you can see how much it saves.
Yeah, and then often I'm kind of uh, go down a rabbit hole here. I get people asking about discount points, right? The other day, yesterday, I think, I don't even remember what day it was. I posted that video on locking your rate. Get people saying, "Hey, should I buy down points? Should I do this? Should I do that?" Exactly what Josh said right there is the reason that you shouldn't buy down points, right? If rates are trending downward over the since 1982, and we haven't broken that trend yet, chances are they're going to go lower. If you're in a position, you might be in a position where you could refinance, take that lower cost without having to actually pay those fees up front. And so, typically speaking, buying down your rate, if you're trying to get your rate down to a point where it will actually impact your monthly payment enough, you're going to pay a pretty good premium to do that. It doesn't make sense if rates are going to continue going lower in the future. So just
It's
something to throw out there.
No, it's a really good point, Jeb. When you look, lenders are really smart. You think in terms of the one loan you are doing and what you think you know about your future. The lenders are making hundreds of thousands of loans. So they know in aggregate, this group of loans will run 4.5 years. So we want to yield X amount, meaning we need to get an interest yield over that time frame to meet our requirements. So if you want a lower interest rate, they say, cool, pay me some money up front. In essence, you are just prepaying the interest over the time that they think in aggregate an average borrower that they're making a loan to will hold that loan. So if you knew for a fact you were going to be there for 12 to 15 years, rates were never going to go lower and give you an opportunity to get that rate for free, it might make sense to pay the points. But the reality is it's a sunk cost. You can never get it back. The break-even point is anywhere from 5 to 8 years, and that's before you take into account tax benefits and the time value of money and what else you could have done with those points in the meantime.
All right.